Welcome to another insightful edition of Investment Acorns, our exclusive series featuring the thought leadership of fund managers at WhiteOak Capital Asset Management Limited. Today we have the opportunity of speaking with Mr. Aashish P. Somaiyaa, the CEO at WhiteOak. In a recent column written for the August issue of Mutual Fund Insight, he delves into the often overlooked yet the crucial aspects of thriving in the market's grey areas, challenging the conventional binary approach to investing. Aashish, thank you so much for joining us.
Thank you. Thanks for inviting me.
Sure. So to start with, in your column, you mentioned that investors are often obsessed with drawing conclusions and giving explanations. Can you tell us a bit more about what you mean by that and how it really affects your investment decisions?
Sure. So, this basically comes from a thought that investing, and this is not just an investing philosophy, it's true even for most things in life, which is that, human beings, all of us, we insist or, we are more comfortable if we have what we call clarity.
Absolutely.
Right? So let's take an example. Say the market falls by 2% in a given day, right? Now you'll appreciate with your understanding that there is a myriad set of factors at play. Like say, for example, if the market falls, people want to say, is it because US economy is doing badly? Is it because of a geopolitical crisis? Somebody will say, no, any which way stocks were overvalued.
Yeah.
And people will try to look for the right reason. The reality is that all these reasons and some more which you don't even understand are at play, correct? So in reality, for most of the things, you have part explanations or you have some explanation, and there is always many things which you just don't know,
Right.
correct? So for being successful in investing and in many things in life, but mainly in investing, for being successful in investing, what I've learned is that you should be willing to live with uncertainty, or you should be willing to live with lack of clarity.
Right.
Let me give an example. You see, in March 2020, some period which we all remember, because there was COVID and the index fell 40%. Now, see, this is so funny. In March 2020, why did the index fall 40%? Because everybody was panicking. People thought that this is a pandemic where case fatality rate will be 5%, vaccines will take 10 years,
Right.
and businesses will be shut for at least 2-3 years. We all will be stuck at our homes. Banks will default. RBI said don't recognize any NPAs. So that was the scenario. So in 2020 March, all of us, we concluded that human beings are the next dinosaur. Up to the world will come to an end. Right? So everybody wanted to just sell everything and run away. But what happened after that? Case fatality rate was nowhere close to what people thought. Vaccine came in 6 months.
Right.
By June, July 2020, we all were roaming around taking flights, of course with a mask. We knew we will get the vaccine eventually. And see what happened in exactly 17-18 months. In October 2021, the index nearly, after 18 months, the index nearly touched 19,000.
Right.
Almost 18,500. So in March 2020, we are thinking human beings are the next dinosaur, the world will come to an end.
Yeah.
And the same people, 18 months later, are saying, "Hamara to Amrit Kal aane wala hai." All trees
Narratives changed.
So what happens is that human beings by nature are deterministic. March 2020, world will come to an end. October 2021, we are going to get Amrit Kal.
Yeah.
So that is very deterministic. See, in March 2020, when everybody thought the world will come to an end, somewhere in your head, if you keep one window open, that no, human beings are basically enterprising people, the world will not come to an end. And in October 2021, when everybody tried to convince you that apna Amrit Kal aayega, trees will grow to the sky, if you kept a window in your mind open, that Amrit Kal aayega, lekin kal subah to nahi aayega na.
It will take time.
So why I said this is because for success, it is important to be probabilistic. And in investing, what keeps human beings away from success is the fact that they are deterministic.
Yeah.
That's the whole challenge.
Right. So you talked about the importance of having a probabilistic approach mindset instead of a deterministic one when specifically dealing with market fluctuations, like you just mentioned. How can actually investors start training themselves to think this way?
See, it's just basically you should understand that, let me put it this way, one of the most revered investors, most successful is Mr. Buffett, correct? And at the drop of a hat, Mr. Buffett's quotes are quoted, like the most famous one being that be greedy when others are fearful and be fearful when others are greedy. So Sneha, let me ask you, who is the others?
That would be the Aam Janta.
That is you and me, it's us. We are the others,
Right.
correct? So the point is that when somebody says be greedy when others are fearful, what do you mean others? Others is, like you said, public. That's all the investors, correct? So when others are being deterministic, you should be probabilistic. Some door in your mind should be open. That is the whole point. Second thing is that how does one practice it? See, what do we tell all investors? That you should have an asset allocation. Right? Never put all eggs in the same basket. Meaning that, who is deterministic? People who say that, ab to equity mein paisa lagao. 100% equity. And then when March 2020 comes, they're saying, fixed deposit, wo bhi State Bank of India.
Right. One-sided approach.
Right? So what happens is that people who are probabilistic, they are the ones who follow asset allocation.
Right.
People who are deterministic, like say for example, last 3 years, small cap, micro cap, SME IPO, railways, PSU, defense, infrastructure, people's portfolios would be loaded with that. Right? Today, if a consumer company declares great results, the stock goes up 15% in a day. Why? Nobody's even looking at it because people get surprised. Nobody's even covering it. Right? So, being probabilistic, people who are asset allocated, people who run diversified portfolios, they are the ones who are covering their portfolio for all probabilities.
Right.
And people whose portfolios are completely skewed in one asset class or in one direction or in one segment of the market, they are the ones who are convinced and who are deterministic कि भाई यही चलेगा.
Right.
So asset allocation is the key.
Absolutely. So moving to the next question, looking at the current market conditions, how would you describe it from a probabilistic perspective? And what might that approach suggest for investors right now?
So, one of the ways in which this gets manifested in clients' portfolios, right, is that if you see, and you guys do a great job of it, so you must have seen that every 2 to 3 years, the best performing fund, the best performing fund house, and the best performing fund manager changes.
Right.
Why does that happen? That happens because a lot of the alpha in everybody's portfolio comes not just from stock picking.
Right.
Bulk of the alpha is coming from being exposed to certain segments or styles.
Right.
Correct? Like today, for example, anybody who is value biased, contra, cyclical, commodity, PSU, they are at the top.
Right.
But they've always been in that bucket. What has changed is the macro.
Right.
Because in 2022, there was a war and US interest rates were going up. So when interest rates go up, everything with short cycle cash flows tends to outperform. Right?
Yeah.
So what happens is that before that, everybody with defensive portfolios did well. But that's not because they knew there will be COVID.
Right.
They were always running defensive portfolios. So what happens is that winners keep rotating.
Right.
And winners don't keep rotating because fund managers lose their skill set or competency. Winners keep rotating because when macros change, different segment of the market gets tailwinded and some segment of the market gets headwinded. So the way this probabilistic thinking in today's environment or in any environment, the way probabilistic thinking can be built in is that don't get carried away by the recent winners.
Right.
When you look at somebody's alpha or outperformance, dig one level deeper and think, is it purely because of stock picking or is it because of just being in the right place at the right time?
Right.
Like Michael Mabuzin wrote this book called Success Equation, where he differentiates between luck and skill. It's internationally well known. We manage money for institutions. The first thing they look for is to see how much of your alpha has come because of right allocation at the right time or right place at the right time.
Right.
And how much of your alpha is because irrespective of the segment of the market, you just did right stock picking. And it is known that alpha from stock picking is a function of competency or skill.
Yeah.
And alpha from finding yourself in the right segment of the market is function of luck.
Yeah.
So all of these things people need to think when they evaluate performance and when they build their portfolios.
Right. So chasing performance becomes kind of a futile exercise.
See, chasing past performance is also deterministic behavior, right? Because somewhere implicitly you are saying, ab tak ye chala hai, aage bhi ye chalega.
Right.
आप ऐसे बोलते नहीं हो, but that is what you're implying, right? Then why are you picking the past performer? So the question is that if you are looking at the past performer, you should know what drove that performance.
Right.
And will those set of factors continue in future? That
And
you need to
across
investigate.
market cycles.
Absolutely, you need to investigate that.
Right. So you emphasize being comfortable in the gray of the markets and avoiding the binary choices. Can you share a few specific instances or examples of how investors can actually apply this when building their portfolios?
Yeah, so 2-3 examples we discussed, right? Let's just flesh it out further. Say, for example, asset allocation is a great example.
Yeah.
Correct? Because asset allocation, when you tell someone that, okay, look, in the last 3 years, equity is what has rewarded people.
Yeah.
Fixed income out of fashion. Correct? Now, if you think that in the last 3 years, because of the experience of having invested in equity and equity rewarding people, people are in our country, people get very carried away with, say, for example, taxation. So fixed income return is low and fixed income is not, rewarding when it comes to taxation.
Yeah.
And equity is what has done well. So anybody who's a deterministic thinker will say, yaar, equity. ये सब asset allocation लोग बोलते हैं, but it's all theory.
Yeah.
But look at it this way, that if US economy were to do badly, right, for some time equity will take a breather because globally all markets get interconnected from time to time. Right. And it would be accompanied by falling interest rates. And what if you get great returns in fixed income then?
Right.
Correct. So people will find that they're underinvested in fixed income because they have been focusing only on the past.
Equity.
Right? So when people stop taking asset class calls and start thinking, look, forget all this. These are my goals. To reach my goal, I need to save for the next 10 years and I need my assets to grow at, say, 10% compounded. What kind of asset class combination I can make which will give me 10% with lowest possible risk? All these optimized portfolios, for example. So all of these are signs of probabilistic thinking.
Right.
When people forget all of this, I read it somewhere that people can't think, which is why they judge.
Right.
So if you buy the past performer, if you say that equity works, those are shortcuts you're taking. That is just you're judging.
Right.
But when you have to really think, you will never pass judgment. You will say that, okay, look, forget all this past, forget the taxation. I need this much return over these many years. What is the least risk portfolio I can make to get this kind of return? That's how people should be thinking.
Right. That's some pretty great perspective.
Thank you.
Moving on, you mentioned that the best decisions are often made with only 60% of the information. How can investors actually find the right balance between, having enough information and avoiding the famous analysis paralysis?
देखिए क्या है, as human beings, as managers, as investors, even if we accept that I have only 50-60% of the information, or even if we accept that I can at best get only 50-60% of the information, that realization and acceptance itself is enough, then we will start functioning in a probabilistic manner and we'll start hedging our bets. Right. Problem kahan pe hai? Problem ye hai ki with little bit of information, people think that they know everything that they had to know. Right. So problem is that people think that they have 100% of the information. No, you never have 100% of the information. Nobody has 100% of the information.
Yeah.
So first step is to accept and realize that it is impossible to get all the information. And given these circumstances, given the context, this is what best I can do. If that way we function, we will save ourselves from a lot of troubles.
Right. Okay, with this we actually come to the last question. So considering your points on human behavior and the market dynamics, how do you think principles from behavioral finance should influence how we approach investing, whether as individuals or be it institutions?
See, I think that, when you look at behavioral finance, one of the things to keep in mind, traditionally what economics you and me were taught in school or college, right? It always assumed that human beings are rational and logical.
Yeah.
Correct. But the revered Nobel Prize in economics in last 15-20 years, at least twice I remember, has been given to people who proved that human beings are not rational and logical. Daniel Kahneman, Richard Thaler.
Right.
So it's a known fact that in the recent times, sometimes the Nobel Prize in economics has been given not to people who studied the economics, what we thought of supply, demand, interest rate and exchange rate. It has been given to people who study human behavior.
Yeah.
Right. So that is something which one really needs to mull about. And if human beings and investors and advisors, if all of us can understand that the key to success, see, like I said, you should be able to thrive in uncertainty, you should be able to
Right.
thrive in gray. If all of us understand that the key to success is not in becoming very, very knowledgeable about everything in economics and finance. Yes, knowledge is important,
Right.
but if you do not have the right temperament, the key is to understand that it is our behavior and our temperament which we need to control. See, there is no end to getting information and knowledge. There's no end to it.
Right. With the social media.
Yeah, I mean, there's
involved in-
absolutely no end to getting information. Just, somewhere you mentioned about explanations.
Right.
Right? So, see, look at it this way. Anything that happens in the market, we look for, oh, why did that happen? Right? If I have a fight with my best friend, if I have some employee leaves me, if the market falls, if US Fed says something, for everything we look for explanation. There's no end to explanation. Everything can be explained.
Right.
But those explanations are not going to change our returns. Right? Because what is not known is not known. That's in the future.
Right.
So there is no end to gaining knowledge and information. But if you can learn to live with uncertainty, and amidst uncertainty, if you can control your temperament,
Right.
I think that is the key to success.
All right. Thank you, Aashish. Thanks so much for sharing those insightful, aspects of investing and thriving in the gray areas of the market. That's all we have in this edition. We'll see you next time.